I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Grant Webster. Grant is the Portfolio Manager for Emerging Market Debt at Global Asset Manager 91, formerly known as Investec. Grant, welcome.
Hi Peter, nice to be here.
Can you tell me what differentiates the EMD offering from 91?
Sure. I think one of the main things, probably quite obvious for those who know us, is that we're from an emerging market. We're a South African firm, and in fact, the name is a reference to our beginning back in 1991, which was a tricky time in South Africa, right? Undergoing a lot of change, and our CEO, Hendrik de Tooy, saw an opportunity there to launch an asset management firm. And so we've been investing in emerging market debt for over 30 years now, initially in South Africa, but then we grew out into Africa. And we had a very meaningful role to play in the development of those markets. So I think that's a major differentiator for us, and particularly when you look at the types of people we employ, where they've come from and their backgrounds, how we manage our funds and how we take risk. That all speaks to our heritage in South Africa.
How has EMD performed recently in the recent market volatility?
Well, it's been a tough market, right? And I think we haven't seen a bear market in fixed income like this for decades. And so EMD was certainly not spared in that. But I think what a lot of people are missing is that actually, and this surprises people, EMD has performed relatively well compared to other fixed income asset classes. And maybe if I give some numbers to flesh that out, over the year so far, the global ag, which is a large global benchmark, is down about 15%, which is a huge move, right? At the same time, the dollar has been around 9% stronger. If you told me at the beginning of the year, that global bonds would be down 15, the dollar would be 9% stronger, Russia's going to invade Ukraine, its bond market's going to go to zero, I would have thought it'd be a bloodbath in emerging market debt. When you look at the numbers, though, EMD is down about as much as global fixed income. So it's demonstrating a lot more resilience compared to what we're used to in the past. If you think of the taper tantrum in 2013, global bond markets weren't really that badly affected, but EMD struggled largely because it was a lot more vulnerable at the time. But coming into COVID and the Russian invasion of Ukraine, we've had a lengthy period of EMs improving their fiscal balances, changing their current accounts from deficits to surpluses. And as I say...
Do you think that's widely appreciated amongst the market observers?
No, I don't think so, not at all. I've been in Australia now for a week, and people are surprised to hear me say this, and point it out to them. I think they agree with me when they see the numbers, and don't get me wrong, these are not great numbers to be looking at. But still, if you consider that of the 15% EM is down this year, 7 was Russia, because Russia, as you would expect, went to zero when those bonds were sanctioned. And so the rest of the market's performing really well. In fact, EM currencies, against anything other than the dollar, are outperforming. The dollar's 9% stronger this year, as I said. EMFX is around 5% weaker. Yes, it's down, but normally, if the dollar was that strong, EM currencies would be down substantially more. So there's definitely some resilience playing out here, which we haven't seen in EM for 10 years.
Well, I guess the $64 question is, what are your expectations for EMD going forward, and why is now a good time, if indeed it is, to get into emerging market debt?
Well, I think all of fixed income looks very attractive right now globally. And the yields that you've built into EM and the spreads above developed market government bonds are substantial. The yields they're trading at now are the highest since the GFC. You have to go way back to the early 2000s to get to a period where we've had yields this high. Spreads on top of government bonds like Australian or US government bonds are nearing the highs we've had since COVID. So that gives you a substantial buffer. You're talking 8-9% yields. We can't quite pinpoint the exact entry point or the peak in these yields. We may have already seen it, in fact, in the last couple of months, because we've had a bit of a rally in the last few weeks. But over the next 3 to 5 years, I think that 8 or 9% yield is going to really, be a really strong driver of returns. So we're a lot more positive on the outlook for inflation right now. That's not me saying inflation is going to come all the way back down to where we were pre-COVID. I think, there's a lot of sort of structural issues in the world that we need to work through.
But it's not going to be as dire as some people are saying or
No,
think.
I don't think so. I mean, the thing is that everyone talks about commodity prices and food prices and how elevated they are. But when you actually look at them, industrial metal prices are down from the beginning of the year. Agricultural prices are down. You've had falls in oil, gas, diesel. They're all 20% off their highs. Where you have a huge shock on the energy side is in European gas because of the way Putin has weaponized gas. And there, absolutely, prices are 20 times higher than where they were in 2019. But it's a single commodity. And in fact, if anything, it's having more of an effect on growth and negatively impacting growth rather than the inflation channel. And I think central banks are going to start looking through that. Increasingly, you're seeing less hawkish speak from central banks. You saw it in the Fed, you saw it from the RBA.
Having said overnight, the UK
Yes.
Central banker has not been too cheery, has he?
No, I mean, they've painted a really gloomy picture for growth further out. Hiked, as you mentioned, one of the biggest hikes they've ever done at 50 basis points. And no doubt there will be a couple more of those hikes. But for fixed income investors, so we're nearing the peak in this. And when you look a little bit beyond that and you see the recession that's coming, remember, lower growth is good for fixed income. It means lower yields, which pushes prices up. And if anything, what's really pushed this bear market in fixed income has been the speed and volatility of the rise in rates. As I say, we haven't seen this for decades now. So if the volatility in core rates, like in the US, Europe, and Australia, can come down, then I think investors can turn to other fixed income markets such as EMD, and they'll appreciate the incredible valuations there, and we'll start to see flows coming back into the market.
We've talked emerging market debt, but we haven't differentiated the types or flavours. There's sovereign debt we're talking about, but there's sovereign debt in USD, and there's sovereign debt in local currency. Can you speak to that issue?
Yeah, sure. So very different asset classes, in fact, which are, again, not always appreciated by investors. So local debt, clearly, as the name suggests, is debt that's issued by emerging markets in their own domestic currencies, whereas the hard currency debt, as we call it, or dollar debt, is issued in dollars or euros, as it can be. So if you look at dollar debt, it's really a credit asset class like US high yield or European IG. It's priced as a spread over a developed market bond rate. And as investors, we're concerned about a country, or indeed a corporate, because you get corporate hard currency debt. We are mainly concerned about their ability to generate dollars to repay us in dollars. So we look at exports and reserves and the fiscal position of the country. Whereas when an investor lends via the local debt channel, what you're doing is taking your dollars, selling them and buying the local currency and then buying the local bonds. It's very similar to an Australian buying Australian government debt. What you're concerned about is not the creditworthiness as such, but rather the ability of the country to control its currency, to manage inflation. And so we look at interest rates domestically as a really important driver of returns there. And of course, these two asset classes perform quite differently in different environments, because local bond yields tend to fall when growth is falling and rise when growth is picking up and inflation is picking up. Whereas on the dollar debt side, what it is it's a credit asset class, so you want higher growth. So it behaves more like a growth asset.
Are you more bullish about one sector than the other?
Right now, we're actually quite bullish on both. We're slowly stepping into both. And let me explain why. The valuations on the dollar debt side are really attractive. Many of the markets are trading at distressed prices. So their actual bonds are around 50, 60 cents. They're not distressed. It's just that yields have risen to such an extent that the cash prices of the bonds are down at those levels. So we like that market for that reason. We think that inflows in the second half of this year could drive yields and spreads lower in that market. But on the local bond side, as we enter this period of hopefully lower inflation, or at least less high inflation and lower growth, local bond yields should perform really well. So we're positive on both of them. We're a bit more cautious on currencies. And the reason being there is that we think the strong dollar could actually continue. The Fed, of course, have hiked rates considerably more than the ECB. The European economy looks very fragile, and in fact, the US relative should outperform. So we're a bit more cautious on EM currencies given that strong dollar environment.
Can you summarise why EMD should be part of the portfolio mix for managers? Is there a short, sharp summary that you can give?
Yeah, I think what's underappreciated is how large the universe is. It's not a $1 or $2 trillion universe. This is a $20 to $30 trillion universe, emerging market fixed income, which people often miss, right? So it almost needs to be a part of a core exposure to global fixed income, but because the yields are that much higher, and it's diversifying you away from the core fixed income markets. If you look at the global ag, only 10% is in your traditional emerging markets, and 8% of that is China. So when you allocate to the global ag, you're really only getting around 2% to your Brazil, South Africa's, Mexico's, those really higher yielding and uncorrelated markets. So that's the reason why we advocate for increasing the exposure.
What does EMD exposure do to that, your global ag exposure? You're saying it turbocharges it.
Yeah, for Australian investors, if you look at it in Aussie dollars, it lifts the yield, it lifts the returns substantially. And in fact, as you add, it decreases the volatility. So the optimal allocation would be about 25% to EMD. That minimizes the volatility, but it's increasing the yield.
And of course, part of your argument is Australians investors are particularly well positioned to benefit from EMD exposure. Can you just give us a little bit on that thesis?
We've been saying it for
years. And how is that thesis received by your listeners?
Well, they appreciate it increasingly. We've been saying it for a long time. Australians are in a particularly unique position. Why is that? It's all because of the Aussie dollar. The Aussie dollar has the highest correlation to emerging market debt of all the G10 currencies. That's because Australia is a commodity-driven economy, right? So when commodity prices are doing well, the Aussie dollar is often strong, and emerging markets are trading well, and typically in that environment. Where the advantage comes in is that in those periods of weakness, when commodity prices are falling and emerging market debt is struggling, you also have a weak Aussie dollar often, right? And that offsets it. Remember, you bought something offshore. So if the Aussie dollar weakens, then that improves the returns when you convert it back into Australian dollars. So what you find for Australian investors, which as I say is very unique, is that the volatility of emerging market debt is substantially reduced, but of course the returns and the yield remain the same. So it really does put Australians at an advantage relative to Americans or Europeans.
Well, final observations, immediate outlook.
Well, as I say, it's tough to call the top in these markets, but we think that most EMs are around 60 to 80% through their hiking cycles, and investors are growing increasingly interested, particularly in those markets. Just this week, we've seen the Brazilians hike for the last time. Last night, the Czech central bank was on hold when they were expected to hike. So we've started to move into local currency rates markets because we think we're really close to the end of that cycle. And of course, as we look ahead to a lower growth environment, that's very supportive for EM fixed income.
Grant, thanks for your time today.
Thanks, Peter.